Hello, everyone, and a very warm welcome to today's Experts for Expats webinar on how the UK's autumn budget affects British expats and foreign nationals living in the UK. My name is Alice, and I'm your host for today. We're absolutely delighted to have you all join us for today's session, where we'll be covering the headlines from the UK budget, which are relevant to expats. And then we'll delve into what these mean for people moving to the UK, those already in the UK, those moving abroad for the first time, and those already living abroad. Now, there have been budget summaries published in every national newspaper, but not much of what's been reported is very helpful for expats, as the newspapers have been looking for the sensational headlines like what inheritance tax changes mean for farmers. But how much of that really matters to expats? So to talk about what the budget actually means for expats, we've got a panel of experts here to share their informed insights. By the end of this webinar, we hope that you'll leave with a clearer understanding of how the budget impacts you in real terms. Now, before I hand over to our speakers to introduce themselves, I'll just explain a bit more about how the session will work. In advance of the webinar, we've asked expats what their most important concerns around the budget are, and we've put these to our panel to inform the content of today's discussion. You're also welcome to ask questions using the Q&A function as we go through the session and participate in discussion via the chat. Please don't share any personal or sensitive information. If you do need specific and personalised help, let us know and we can arrange a formal introduction to an expert in our network. We've created a specific link for this and that will be shared in the chat as well. Nothing in this webinar constitutes advice and you shouldn't rely on it to make any decisions. Always seek tailored advice from trusted professionals. Now, as this is a webinar, you're not on camera or on audio, but to the right of your screen, you'll find the chat box where you can communicate with other attendees and ask questions. To ask a question, simply type it into the Q&A or the chat box, and we will do our best to answer them during our panel today, but we have a lot to cover. You might also see some polls pop up during the session, which you'll be invited to vote on. If you encounter any technical issues at all during the webinar, or if you have any additional questions, use the chat to inform us and we will get back to you. The webinar is being recorded for future reference and the recording link will be shared with you after the event. So let's get started. A warm welcome to our panel of experts. I'd like to invite you to introduce yourselves, say a bit about your expertise, and also share your one key headline from the budget, which is relevant to expats. So Jamie, let's start with you.
Thanks, Alice. Hi, everybody. Thanks for joining us this afternoon. My name is Jamie Favell. I am a private client tax partner at Tax Advisory Partnership. I'm an expert in UK domestic tax and the special rules which apply to expats and non-domiciled taxpayers here in the UK. My one key headline from the budget for expats is the UK remains a pretty tax efficient place to be. So despite all the doom and gloom in the headlines, there's some good news here which we'll be able to talk about today.
Brilliant. Thank you, Jamie. Jane.
Hi, everybody. I'm Jane Cowie. I look after a company called IUK Global Style. It's a Swiss-based financial advisory service, and we look after expats probably throughout most of the world, with the exception of the US. In terms of the key headline from the budget, I think most people who have left the UK will quite often have some form of pension retained benefit. And we get an enormous amount of inquiries. I'm sure we will have a lot more people who will want to talk about what their options are with regard to the new rules.
Brilliant. Thank you, Jane. And Max.
Yeah, hi, good afternoon, everyone. My name's Max Hussain. I'm a senior account manager for Money Corp. We work closely with experts for expats and their expats to ensure that they have a robust process when moving funds internationally. My one takeaway from the budget is that it was a little bit of a non-event from an FX perspective, but there's been lots happening since that is moving markets that I'm looking forward to talking through with you all.
Great. Thank you so much, everyone. So before we move on to the main discussion, we had a lot of questions about tax. So I'd just like to invite Jamie to provide a brief overview of the key tax changes affecting expats.
Thanks, Alice. So most of the changes which impact expats were actually announced in the Tories' last budget in spring 2024. In that budget, we were told that the non-dom tax regime was going to be abolished and that it would be replaced by a new foreign income and gains regime, which is now known as the FIG regime. We've now since had the Labour government's first budget, and that has given us some clarity and some detail that was missing from those original Tory announcements, which means we can now advise non-doms, expats on a more informed basis so that we can plan properly. Now, the main change for non-doms is that the non-dom regime will be abolished. So from 6 April 25 onwards, the non-dom tax regime as we know it, so the ability to claim the remittance basis, shelter foreign income and gains from UK tax, has gone away. That change presents some planning opportunities now, between now and the 5th of April for non-doms, which we'll talk about a bit later, and has also been introduced with some transitional reliefs. So there are certain reliefs, we have a bit more clarity over those for non-doms as we go into that new tax regime. There'll be the ability to rebase the value of your overseas assets, and there'll be some transitional reliefs which will allow non-doms to remit overseas funds into the UK. And we now know what those tax rates will be. So in the first 2 years of the new regime, non-doms can remit funds and pay a 12% tax rate. In the 3rd year, they can remit some funds and pay a 15% tax rate. That facility is going to be known as the TRF, which we'll talk about again a bit later. Now, the main changes which we now know for expats are around the foreign income and gains regime. They're of most interest to expats that haven't been resident in the UK in the previous 10 years. So expats coming here for the first time, or maybe expats that are straddling that 4-year period. So you might have been here for a year or two already, and you might be able to benefit from this new regime post 5 April 2025. The new regime really simplifies a lot of the old rules that we had, I guess, because what it's going to mean is when an expat comes to the UK for the first time, for a 4-year period, you won't have to declare any of your overseas income or gains in the UK. So they'll be exempt from UK tax, and those funds will be able to be brought into the UK without any penalty or any further tax charge. So that's great. We've now got clarity over the types of income that the foreign income and gains regime will apply to, because we didn't have any of that detail. And that's going to make planning for an expat when they first come to the UK much more straightforward. There have been lots of complications in the past with regards certain overseas investments not being very efficient for UK purposes and vice versa. And this 4-year window now gives us a period where we can clean up some of those prior complications. What's also been confirmed is the treatment of overseas work days relief. Expats that come to the UK for the first time will be able to claim an exemption from UK tax in respect of their non-UK work days. Under the old non-dom tax regime, that relief was restricted to a 3-year period. It's now been confirmed that actually we'll have a longer shot at claiming overseas work days relief now. We'll have a 4-year period, which is aligned with the new FIG regime. So that's really good. That's a great benefit. The other changes which have been announced, if we've got private equity executives moving to the UK for the first time, carried interest will form part of the foreign income and gains regime. So we'll be able to exempt some of your carried interest gains or private equity income from UK tax within that 4-year period. Capital gains tax rates for carried interest. This current tax year, we've got a special rate of tax, which is 28%. That's increasing to 32% from next year. And then from 26-27, there's going to be a reform of how carried interest is taxed in the UK. Other headlines, we were told all taxes were going to increase. It was all doom and gloom. everything has increased, but it's not as bad as it was suggested it might be. So now the UK now has a highest capital gains tax rate of 24%, which applies for normal gains and real estate gains. And we've got various special rules that have been introduced for business assets. And finally, so I'm going to run out of time. Other major changes are around inheritance tax. We are moving to a residency-based inheritance tax regime. So the domicile is out of the window. We've now got a 10-year regime. So if you've been UK resident for 10 years, you're within the UK's inheritance tax regime. That is a 10 out of 20-year window. Once you've been a UK long-term resident for a 10-year period, you're subject to UK inheritance tax. There's some planning we can think about around that. Pensions are being brought into the UK inheritance tax net too. Previously, they've been exempt from UK estate tax. They're now not, and there's some planning that we need to think about there.
That's brilliant. Thanks, Jamie. And we'll go into more detail on all of this as we go through the discussion as well.
I know. There's a lot to think about. So it's really a broad summary.
Yeah, absolutely. It was brilliant. Thank you. So now we'll delve into the main discussion for today. If you have any questions as they come up, please do put them in the Q&A and in the chat, and we'll do our best to bring them in as we go through. So first of all, we want to explore what the budget has changed for expats who are moving to the UK for the first time. So in terms of the questions we had in advance, one of our attendees asked about moving to the UK from Canada, the impact of currency fluctuations. People have asked us about changes to non-dom status, as well as tax implications on retirement funds. So Jamie, let's start with you. What has the budget changed for expats who are moving to the UK for the first time?
So if you're moving to the UK for the first time, previously, under our old regime, if you were a non-dom and you were moving to the UK, you could probably access the remittance basis, even if perhaps you'd been resident for a year, a few years ago, you could still come to the UK and access the remittance basis in some shape or form. Now, if you've been UK resident in any of the previous 10 years, then from 6 April 25, when you move to the UK, you'll be taxed on your worldwide income and gains, and you won't have any option to exempt your foreign income and gains from UK tax, because the new tax regime, the FIG regime, can only apply if you have been non-resident for 10 years. So you have to be non-resident for 10 years prior to your first year of UK residence. That regime does extend, as I mentioned earlier, to someone that might be straddling the old and new regimes, are already here but been here a year or two, providing they also had been non-resident for 10 years prior to coming to the UK. So if you're moving here for the first time, great. All your foreign income and gains will be exempt from UK tax for the first 4 years that you're here. If you're coming to the UK to work, which a lot of expats will be, highly skilled workers coming here to work, you'll be able to access overseas work days relief. That means that if you're traveling overseas for work, we'll be able to file a tax return and exempt your non-UK work days from UK tax. That would apply to your salary, maybe to other awards, share awards, that type of thing, your bonuses. That can make the UK really tax efficient in these first 4 years that you're here in the UK. The important thing to know is that the FIG regime will need to be claimed via a tax return. Similarly to the remittance basis that applied before, if you are looking to exempt your foreign income and gains from tax, you will lose your entitlement to the personal allowance, the capital gains tax annual exemption, and you won't get any relief for foreign losses that you incur. Other things just to note, if I've got time, pre-arrival capital is not subject to UK tax. You'll be free to bring those funds into the UK. If you're coming to the UK and you're looking to buy UK property, careful consideration is just required around stamp duty land tax. That has increased. Announcements were made in this budget which weren't expected. If you already own a property and you're buying a UK property, you could be subject to a 5% surcharge on our normal SDLT rates. So that needs some careful consideration. It might not apply if you're replacing a main home that you've sold overseas. But otherwise, if you retain that home, you buy a new property in the UK, you get lumped with a 5% surcharge, which would be expensive.
Thanks, Jamie. Jane, what are the kind of main implications for people moving to the UK for the first time?
Okay, I think as much as anything, it's very, very important to make sure that your assets are lined up from a tax perspective so that you fully understand the implications in coming to the UK, looking at the sort of the relevant scenarios with regard to the taxation that you can expect to pay, but also to check with your existing tax people in the country that you're leaving to make sure that you know all your ducks are lined up and you know how those assets might be treated as a non-resident of your former country. So there's two handles on it as well. Then you have to look at the assets themselves, what you're leaving behind, and what you may in the future be employing in the UK if you're staying in the UK. So, you know, have a look at your pensions. In most cases, you can retain existing pensions and you won't be taxed on them in the UK until you're taking the benefits. But at the same time, if you're planning to stay, it's then perhaps a longer conversation to have a look at those assets to see how that will then work into your plans to remain in the UK going forward. And on top of that, then to also think about how that will work for you from a perspective of those assets being held in their existing currencies in the country that you're leaving. So, for example, somebody who was talking about Canada, they may well have what are known as RRSPs, retirement plans that they'll hold in Canadian dollars. They may have tax-free savings accounts, which are the kind of smaller equivalent of UK ISAs. So, for example, in that circumstance, it's a case again of considering whether or not you're going to leave those assets there as they sit, and then they're treated as foreign assets for UK taxation reporting, or you then look to review those and to consider whether or not it's relevant to replan those, should we say, by bringing them into the UK and possibly looking at currency conversion.
Thanks, Jane, which leads us very nicely onto Max.
There's a perfect segue there. I just couldn't come off quickly enough. Thanks, Jane. Well done. So, look, I suppose if we look at short term, so like post budget, there's been very little reaction in the currency markets to the UK budget. So I will focus on the Canadian dollar as that was what the question was asked about. But if you consider going back to the mini budget from Liz Truss, when we saw sterling fall to its lowest level since 1985, there really was limited reaction. We've seen a lot more reaction post US election, post Bank of England meeting today as well. And with the Fed speaking tonight, interest rates are really the main drivers. And I'll cover that off as we move through this webinar. But with regards to this specific question, I think it raises a really interesting point. So firstly, on the foreign exchange movements that we've seen. So post-budget, pound against Canadian dollar specifically has increased by 0.37%. So certainly not something that's going to drive decisions of people looking to come to the UK. That being said, if you look back a little further, the pound strengthened by nearly 6.5% in the last 12 months against the Canadian dollar. So for those that are looking to bring assets into the UK, it's really important that they understand the risk the FX volatility can have on the wealth that they're bringing into the UK. A bigger point, and Jane touched on it, all around like planning and making sure you've got everything lined up so that you know you can manage a smooth transition. Canada specifically, unless you're in country, is notoriously difficult to get funds out of, purely for the fact that unless you're in branch, it becomes very difficult to move funds out of your account in large amounts. So you're then moving smaller amounts over a longer period of time, either online or over the telephone. Now, every jurisdiction is different. Everyone has a different type of banking arrangement, regardless of where they're living. I think the important message here, though, is to understand what capabilities you have well in advance of moving out of country, so there are no nasty surprises once you've left, and that will go from tax to financial planning to FX and all the other things that expats need to consider when moving abroad. But specifically in Canada, to the person that answered this question, make sure you know how you're going to move funds out of Canada before you leave, so that you don't hit a stumbling block as soon as you land in the country of your choice, if it's the UK.
Brilliant. Thanks, Max. We've had a couple of questions come up that I'd just like to address before we move on to the next section. So the first one we've had says, if you are a UK citizen and returning and you'll still have a few investments in the US, will that be taxed? Jamie, maybe this one's best for you, and then maybe Jane as well, if you've got anything to add.
Yeah, it's a good question. So if you're a returning UK citizen, you're equally entitled to access the FIG regime. So providing you've been non-resident for 10 years and you returned, then your non-UK income and gains will be exempt, and that will include I would expect most US sourced income and gains.
Thanks, Jamie. Jane, did you have anything you wanted to add here?
Not really, apart from the fact that obviously the reporting, the investments that are compatible in the US are entirely different to the UK. So the reporting of them remains with the US. So it's worth thinking about whether or not to disinvest from those investments, to avoid future struggles with that. But by and large, no, it's as Jamie says, if you can take advantage of the non-dom regime coming back in, then yeah, why not?
Yeah, and thanks, Jane. And it's certainly the 4-year exemption gives you an opportunity to do that cleaning up and restructuring that Jane mentions, because post 4 years, there are a lot of US investments you don't necessarily want to hold if you're UK resident.
Yeah.
Thank you both. And then we've just had someone ask for some clarification, Jamie, from your tax overview as well, which is what determines whether 18% or instead 24% is applied for capital gains tax?
Yeah, that depends on your marginal rate of tax. So the lower rate applies to any gains which fall within your unused basic rate tax band. So if you have no other income, for example, but you have, broadly say £35,000 of basic rate tax band available, then any gain that falls within that band will be taxed at the lower rate. Anything that falls within, if you're a higher rate taxpayer, then everything will be at the higher rate of capital gains tax.
Brilliant. Thank you, Jamie. And then just one more question before we move on to staying in the UK. Someone has asked, if a UK resident non-dom has overseas money, i.e. Isle of Man from OWR, can it be brought to the UK from the 6th of April 2025, attracting only the 12% tax to be paid in the UK?
Absolutely. Yeah, that's something that we'll be speaking about in a moment for those that are staying in the UK.
Brilliant. Thank you. Which is another beautiful segue. So moving on to the implications for expats staying in the UK. So, here we understandably had a lot of questions about non-dom status and inheritance tax. So Jamie, I'll come to you first again here.
Okay, so yeah, so focusing now on individuals that are already here and are staying in the UK. I think the first thing to consider is how long have you been here? Can you access the new foreign income and gains regime and optimise that position for any further tax years post 5 April 25? And then we need to think about planning before the new regime comes into force. So we've still got a window of opportunity between now and the 5th of April for non-doms to claim the remittance basis, if that's relevant. A non-dom now in this period might think about whether they can exhilarate overseas income, shelter it from UK tax, claiming that with a remittance basis claim, whether they should be selling assets, sheltering them from UK tax with a remittance basis regime in order to rebase their value for capital gains tax purposes. They need to think about the impact of the rebasing of assets to their 5 April 2017 value, which will apply post 5th of April, and whether they can optimise some tax positions with reference to that. We need to think about the point that one of those questions just referred to, the temporary repatriation facility, the TRF. Some of the TRF rules will make clients need to think about realising income and gains now pre 5th of April in order to shelter them from UK tax at today's rates, remit those funds later on, either at a 12% rate or a 15% rate. It might mean that, for example, we have a lot of clients that are planning to bring significant amounts into the UK. Perhaps they've been sheltered from UK tax. Life circumstances have changed. They now want to buy UK property. And over the years, we've done lots of mixed fund analysis to work out what the UK tax exposure is on remitting those funds. Post 5th of April, that's going to be more straightforward. So if taxpayers were planning to remit before 5th of April, they should probably delay that now, or at least do an exercise to work out today's tax exposure versus the tax exposure remitting under the TRF. It's not as straightforward as it seems, because we need to think about interaction with double tax treaties, the fact that foreign tax credits won't be available to offset against the TRF tax charge and that type of thing. One other thing to think about is restructuring assets before 5th of April, looking how you hold your investments, thinking about using offshore bonds, thinking about family investment companies or family partnerships to hold investments, that type of thing. And finally, if you're staying in the UK, you do need to think about the inheritance tax changes, this new 10-year tail that we have that will bring taxpayers into the UK inheritance tax net. If you want to avoid that at all costs, then you're going to need to leave the UK before the 5th of April. Alongside the IHT and estate tax changes, there's been quite a huge reform around the taxation of offshore trusts. So if you are the beneficiary or the settlor of an offshore trust, then you need to review your arrangements now and see if there's any planning that you need to do to make your life more straightforward post 5th of April.
Great, thanks, Jamie. Jane, over to you. What do expats staying in the UK need to know?
Well, I think as much as anything, the important thing here is we're coming back to the tax changes again, which is obviously Jamie's bag, but it's so important really for these changes and transitional arrangements to be worked out and considered thoroughly, so that no mistakes are made, because obviously you don't want to head off in the wrong direction and perhaps miss deadlines and that kind of thing. So from that point of view, it's really important to take advice from professionals if you're struggling with understanding the rules, to make sure that you get a good handle on what is going to be the best scenario for you from a tax point of view. That then feeds through into looking at various investments and savings and that kind of thing, and perhaps restructuring those. Don't forget, if you're staying in the UK, you will have the opportunity to use ISAs, which are the tax-free investment and savings allowances in the UK. The UK is probably the most generous jurisdiction for tax-free savings investments. You get a £20,000 allowance each year that can be invested into or saved. It can be cash savings as well as investments. It's a really, really beneficial allowance. And if you're staying, you can build that up over the years by adding to it each and every year. And then that can complement further down the line when you eventually look to retire, how you would draw retirement income. So perhaps after the tax-free lump sums that are available through UK pensions, any income thereafter that's drawn down is then not only inheritance tax now, but on the income side, it goes through the marginal rate, so you'll pay tax on it in the UK. However, if you have a portfolio of ISAs that you build up through sort of prudent savings and adding to those each year, you can actually draw from that fund further down the line, either in lump sums with no tax at all, or in income with no tax at all. So that can create quite a difference to how you will look at tax-free income going forward. So that's just a typical example, really, of some of the things that we talk to people about and consider, without being too specific. But it's just vital to make sure you've got the tax saving side and the knowledge of how your assets are going to be treated lined up, and then look at how you might restructure those assets.
Great. Thanks, Jane. And Max, is there anything from an FX perspective to add for expats staying in the UK?
So we've seen stagnation from like non-doms in the UK on making decisions. So what's really positive is that we've got some clear direction, like as per Jane and Jamie's communications, like seek the guidance, speak to an expert. But yes, specifically within like the property markets and those that are waiting to either bring funds to the UK or take funds out of the UK, we have seen non-doms waiting. So what the budget does is give them clear insight on how they can move forward. So it hasn't impacted FX markets or exchange rates, but we can certainly help non-doms that are thinking of either leaving on the back of the recent changes or making additional investments into the UK to ensure that they have that robust process for moving their funds from A to B. Outside of that, not a huge change within our space.
Thanks, Max. There's 4 questions that I'd really like to ask that have come in the chat, so we'll see if we can get through them. So the first one is, I have some cash in CHF in an offshore account, which are savings from a previous work in Switzerland, taxed in Switzerland as I was resident there. It was never invested, just sat cash. Will it ever create a tax liability just for bringing it into the UK either before or after 6th of April?
I'll answer that, Alice. I wouldn't anticipate that it would. It would be considered clean capital for UK purposes. So it will only be the growth and income generated from that capital that would be taxed if earned once UK resident.
Perfect.
Can I just jump in there?
Yeah.
So whilst we have seen limited movement across FX markets post-budget, the pound against the Swiss franc is certainly one that we have done. So the pound's increased in value by 1.8% in the last 7 days. So a significant move. Now, across the year, we've only seen a 2.2% increase in the pound's value against the Swiss franc. So whilst I can't specifically say this is a result of the UK budget, obviously ongoing events within the US and the UK are having direct impacts on this currency pair. So one to certainly watch out for.
Great. Thanks, Max. So this next question could be answered by anyone. How much of this advice is completely solid and how much is still dependent on the government consultation, which I thought continues until mid next year? Jane, do you want to take this one? You're nodding.
I think, particularly with pensions in the UK and the IHT announcements, which is quite a new thing, there's going to be quite a lengthy pension consultation through HMRC. So obviously, it's not pure speculation because in most cases, you can sort of see where most things are going. There probably won't be huge policy changes. It will just be the determination of how those pension assets are calculated and treated in the event of a death or how they're passed on. So, there will be some, not changes, but some further announcements as a result of the consultation, which really just define what it really means.
Brilliant. Thanks, Jane.
Alice, just to answer that question with regards to the non-dom regime and the foreign income and gains regime, I think those changes are solid now. They're what we should expect to see for the next few years.
Great. Brilliant. Perfect. Okay, so next question. I'm German, married to a Brit, and I've lived here since March 2020. My German pension will start in 2027. Until now, I've got a house in Germany, which is rented out, and the rent was taxed in Germany. From when do I need to file UK tax returns for the house rented out in Germany and for the pension, which will start in 2027?
It's a very specific question, and I don't want to give any answers which are going to worry anybody or scare anyone in this forum. Potentially, you should be filing tax returns already, at least to ensure you're claiming the remittance basis so that you don't have to declare the German rental income. Because even though it's being taxed in Germany, in the absence of a remittance basis claim, it would also need to be declared and taxed in the UK with a credit given for the German tax that you've paid in order to avoid double taxation. So probably you should be filing now, I think is the answer. And you probably will need some advice around your situation, I'd suggest.
Great. Thank you, Jamie. Jane, did you want to add anything here from a pensions perspective?
I think generally what you'll find is that the pension may well be taxed in Germany. My experience is from the UK side going the other way. So subsequently, you will find that expats will often be taxed in the UK, and then they'll have to do some form of reclaim from HMRC, offsetting the dual tax via the dual taxation treaty. But what Jamie just said there is very relevant, because people quite often just assume that the dual taxation treaty just will relieve that taxation, but there is a process step that has to be taken, i.e. to claim the remittance basis or whichever it needs to be, to make sure that you actually do access and benefit from that treaty.
Great, thank you, Jane.
I'd just like to touch on that point as well. Whilst it's not directly answering the question that was received, obviously we work a lot in the space with people that are remitting pensions from abroad to the UK. The pound against the euro year to date is up by 4.5%. So that means that particular individual, unless they've got this managed well, is getting 4.5% less this month than they were at the start of the year. And depending on the amount of the pension, could have a sizable impact on what they actually receive. So it would be advisable for that individual to make sure that they've got a process in place to manage that effectively via the Experts for Expats network.
Great, thank you so much, Max. Okay, just one more question before we move on to expats moving abroad. Jamie, I think this one's just going to be for you. For non-DOMs in the UK for more than 4 years, what is the base date to calculate clean funds from earned income? Is it the date of arrival in the UK? And if such income is brought to the UK, how is it taxed?
Moving to the UK doesn't change the classification of your overseas income, capital gains, whatever you've got pre-arrival. Moving here doesn't change the classification. What doesn't happen, which is a common misunderstanding, is that assets don't get rebased to their current market value on the date that you move to the UK. So you do need to think about pre-arrival planning before you come here. You need to think about whether it's the right thing to restructure pre-arrival in order to rebase the value of your assets, in order to establish clean capital before you arrive. But the actual, if you've got a bank account with X amount of funds in it, with pre-arrival, that's always going to be clean capital. Have I answered the question there, Alison?
I think so. Please do feel free, the person that asked the question, to let us know if that has been answered, and if not, feel free to ask for further clarification. Okay, so let's move on now to expats moving abroad. So in terms of the questions we had submitted here, lots of people asking about implications for rental property income if they were to move abroad and rent out their UK property, about mortgage rates, lots about capital gains tax, selling a UK property, and moving money out of the UK as a result. So Max, let's come to you first on this. What are the kind of currency impacts for expats who are moving abroad from the UK?
So yeah, I think that, as I've mentioned throughout, there's been relatively little impact post-budget on the major currencies. That being said, the expats, or the people that are leaving the UK and moving abroad, are likely going to have property that they need to sell. They're going to need to have assets that they need to liquidate to begin their life in the new country that they're moving to. That comes with an element of FX risk. So I think It's about, again, making sure that you understand exactly what you're doing well in advance of that. Because for example, if you look at clients moving to the US, we've seen a 14% variance year to date. With Donald Trump coming in as president, it's widely expected that the dollar's going to strengthen, specifically looking at the fact that he's got the presidency, the House and the Senate. So that means, or the forecasts are that the dollar's going to strengthen significantly. So if, for example, you've got someone that's selling a property in the UK looking to move to the US, the funds that you're going to get for that property sale now or in the future with Trump as president could look very different to what they do today. So it's about planning accordingly to make sure that you've got the right tools in place to mitigate that risk within a currency perspective. And then if you do decide to keep the property in country, and move funds out or use it to cover your mortgage, it's about understanding, again, the process that you're going to need to follow if you're going to be moving funds to the country of your current location. So again, just getting ahead of the game and making sure that the planning is conducted thoroughly.
Fantastic. Thanks, Max. Jane, we'll come to you next.
Yeah, sure. So there's quite a lot to consider when you're renting out a property for the first time if you're moving abroad. And these are steps that aren't just about taxation. So generally, if somebody's renting a property out and they've got a mortgage against it, the first thing they need to make sure of is that when they speak to their mortgage lender, they've got consent to let the property out. They may have a residential based mortgage with the appropriate residential interest rate applied. So they will need, and part of the terms and conditions of that mortgage agreement will usually be that the property isn't rented out. In some cases, this may change how the lender considers your mortgage. They may wish to renegotiate your mortgage deal and apply a slightly different interest rate, normally a little bit more expensive because it's then being classified as a buy-to-let type of mortgage. In some cases, they may allow any fixed mortgage period to come to an end before they actually renegotiate or make any changes. And don't forget, of course, that though the premise on which your mortgage has been calculated will have been on your income if it's your residential property. Whereas when it becomes a buy-to-let property, they will usually want to recalculate based on the rental income that's actually being received. So these are things to just check with your lender. In terms of insurance, if you have property insurance that covers buildings and contents insurance will normally not be there if you are living outside of that property for more than 30 days. So you'll need to have what's known as landlord insurance. And that just means that it will cover your property so that if anything does happen, the insurance company are aware that it's a rental property. Finally, from a tax point of view, you'll need to register under the non-resident landlord scheme with HMRC. And what that means is that basically, as things stand at the moment, if you don't have that in place and you're using a managing agent or an estate agent to rent the property out, they will have to make a percentage of your pay a percentage of your rental income directly to HMRC. The agreement will allow you to receive your rental income gross from HMRC and then complete a self-assessment return to HMRC at the end of the tax year, during which period you then complete your tax return and obviously pay any appropriate tax. If you're a UK individual, you may not have any tax to pay because you'll have your single person allowance that you can offset against that tax. And that might be a single person allowance you're no longer using for any other purpose because, of course, you've moved abroad, you may well be working under a different tax regime and being remunerated differently. So that's another thing. What I would then say is you then also do need to consider how that rental income is then impacted on your circumstances in whichever jurisdiction you've moved to. Because obviously, if you're then receiving this rental income that's foreign income and being relieved by the UK tax provision of the single person allowance, you've suddenly got a chunk of income which is then falling into the tax regime of the country in which you're living. And particularly if, for example, you're going to Spain, you have a different scenario, which also includes completing something known as the Modelo 720 form, which basically means you have to not only declare that income, you also have to declare the fact you have that asset outside of the UK.
Thanks, Jane. Jamie, Any further tax considerations for expats who are moving abroad?
Sure. So there wasn't much that came out of the budget. Obviously, we've touched on the changes to inheritance tax. So if you're leaving the UK, you will need to understand if you've remained in the UK inheritance tax regime. If you're leaving before the 5th of April, you might still be within their regime, depending on whether or not you're already deemed domiciled here. You might have an IHT tail for 3 years at least after leaving. But for taxpayers generally that are moving abroad, first you need to think about your residency planning. When are you going to become non-resident? Do you apply for a split year? If you're dependent on a split year for tax purposes, what do you need to do to ensure that that is automatically applied? So you need careful residency planning. You then need to think about the ongoing taxation of your UK source income. Usually income is taxable where you're resident. Jane has just explained much better than I can around the one piece of income which usually remains UK resident, which is UK real estate. Most other things will be taxed wherever you've moved to. It's important to know that if you retain your UK property but then sell it once you're non-resident, then your capital gain will be subject to the non-resident capital gains tax regime. That has some special methods of calculating the potential gain for UK tax purposes. And you can choose the one which is most optimal for you, which produces the lowest amount of UK capital gains tax. So you look at the original cost calculation, a default calculation, which allows you to rebase the value of your property to April 2015, or you look at the gain that you have on the property on a straight line basis and how that straddles that April 2015 date and calculate a gain for UK tax purposes. The main residence exemption would still apply if you're non-resident. So if actually it was your main home and you only left the UK a short while ago, it's probably exempt from UK capital gains tax anyway. The other thing to think about if you're moving abroad are our temporary non-resident rules. So if you leave the UK only for the short term and return before 5 years have passed, you have to think about any UK source income and gains that you might have realised during that temporary period of non-residence. Some of those gains might come back into UK tax charge if you return to the UK before 5 years have passed.
Thanks, Jamie. We've got a couple of quick questions I'd just like to ask before we move on to the final section. So we may overrun by 5 minutes or so. So the first one is, what are the rules for money held in ISAs if you move abroad and become non-UK resident? Jamie or Jane, did you want to hop in on this one?
Yeah, I mean, they're tax-free in the UK, so you have no income or capital gains tax. And if you retain them, that will remain the case from a UK perspective. However, they're not tax-free elsewhere. And you'll normally need to report gains and declare income on them wherever you are in the world.
Thanks, Jane.
I'll just add for interest for other expats, on the flip side, similar complications arise if you're moving to the UK and you've got tax exempt investments, which might work for the US or Germany or France or wherever it might be. When you move to the UK, we're unlikely to recognize that tax-free status. So you need to think about restructuring there as well.
Great. Thanks, Jamie. And then one more question before we move on to our final part. Is it possible that the UK government will introduce a deemed disposition of assets for capital gain purposes for current UK residents who emigrate from the UK?
Pre-budget, lots of commentators were suggesting that it was a risk, including notable kind of King's Council advisors that we'd been speaking to. It wasn't mentioned in the budget. Hopefully, it's just something that's was being written to make headlines in newspapers and things like that, and it's gone away. But perhaps it's still a risk that is bubbling away because exit taxes are a thing. They do exist in Canada, Denmark, other jurisdictions. So it is a risk. It would be pretty nasty if it is introduced, and it would see, I think, brain and wealth drain from the UK. So hopefully the government have been listening to clever people who have been advising them not to do this.
Thanks, Jamie. Okay, so we'll move on to our final section. So this is around the budget implications for expats who are already living abroad. So here we had a lot of questions submitted around the implications for expats with UK pensions and investments. So Jane, let's come to you first on this one.
Sure. Okay. So it's a big part of what we do. So subsequently, we have a lot of people that have what we call retained pensions in the main, pensions that perhaps they've left behind. They've come from former employment, so they're sitting there, and people have a lot of different segments. Quite often, they might have 4 or 5 pensions from their working life in the UK. And this particularly applies to people who retire abroad, go off to the sun, maybe to Spain, Portugal, France. And what do they do with them? And then it's a case of actually sort of considering, how they will take their benefits from them. Many of those pensions quite often will have what we call legacy schemes. So they don't fall into what's known as the drawdown system that the UK made available with the Pension Freedoms Act, when that all changed in 2015. So subsequently, people will have these old schemes and then possibly not be able to do anything with them. And it's a case of actually having a look at, what they have in place, gathering that information together. And don't forget, it can sometimes be a lot more difficult to find it once you move abroad, particularly when these are quite often schemes that you may have lost track of as well. So it's a case really of checking what you have, what those provisions are, and then seeing how you're going to be using them and what you need to do with them further down the line. Obviously, there's no potential need for touching them if you're at a young age, potentially. It just depends where you're going to end up. Some people may be returning back, but it's quite often people will consolidate into one type of scheme that now allows them the most flexibility in terms of, when they eventually take their benefit. So it's really a sort of a housekeeping exercise, I suppose, as far as that goes, from the point of view of just seeing where they are. And I know it's not necessarily budget related, but it's a case of we speak to so many people that suddenly want to take their pension benefits if they've retired and find that they're almost locked out of them by UK pension providers because of various rules around advice giving and that type of thing. Investments, again, obviously they'd be potentially UK centric. So it's a case of seeing what the compatibility is in the country that you're going into. But once again, as Jamie mentioned, those assets are usually reportable under the rules for being resident in another country, where in most cases, worldwide income and gains is usually taxed unless you're under specific regimes which do relieve them. So it's a case of really checking where you're going to and seeing how it will fit from a point of view of what you have in place, and then how you talk about restructuring, planning and retention.
Fantastic. Thanks, Jane. And Max, what about from a currency FX perspective?
Yeah, again, like similar to Jane's piece in that it's not necessarily budget related, but just good best practice. So less so with accessing your pensions, but more with your investment. So obviously moving your investment from the UK abroad is going to come with an element of currency risk and volatility. So it's about ensuring that you're liquidating the investment at a time that also ties into a strong currency movement. So for example, if we see the pound weaken by 3 or 4% and investments up by 4 or 5%, that increase in the investment is negated potentially by any foreign exchange volatility. Obviously can work out in clients' favor. Over the last few years, we've seen people that have become expats in the US and bought property in Florida buy when the pound was really high. They've now sold their property in Florida for a huge market increase in that part of the world, and also benefited from a weak pound over the last few years against the dollar. So it's just being aware of the potential implications of foreign exchange volatility and planning from the outset.
Great. Thank you, Max. And then Jamie, what about the tax considerations post-budget for expats who are already abroad?
Sure. So again, just focusing on pensions, lots of expats that are abroad that have UK pensions will have retained them, perhaps in the knowledge that they would have been exempt from UK inheritance tax. That is changing as currently proposed from 2027. So those pensions will be in the UK inheritance tax net. So lots of expats that perhaps have no other connection to the UK other than their pension now are at risk of being subjected to UK estate taxes. So probably need to think about what planning they should do in that regard. There have been some headlines around the changes to QROPs. The QROPs, aren't something that we've previously spoken much about planning wise with our clients, because we preferred clients to rely on treaty planning and taxing rights for pensions through a treaty, because estate tax hasn't been an issue. Perhaps QROPs will now become more popular in order to take pensions out of the UK, subject to carefully managing any risk around the overseas transfer charges. The taxation of pension income will usually be in your country of residence, as Jane said.
Just on that, Jamie, as well, when you're actually moving funds within one of these vehicles, ensure that it remains within, from a regulatory perspective, it remains within the wrapper. So again, planning from the offset and understanding the options that are available to you is exceptionally important, so that you don't end up with a liability because you've sent funds in the incorrect way.
Thanks, Max. Okay, so we've got a few more questions just before we wrap up. So first of all, Jamie, I think this one's for you. Can you clarify or confirm, with the abolition of non-dom status, does that mean that any assets held by a non-resident outside the UK are outside IHT?
So a non-dom that is in the UK, their non-UK assets will be within the UK inheritance tax net once they're considered long-term residents, a resident in the UK for 10 out of the previous 20 years. So they would be in the UK tax net. Now, we haven't touched on because it's a bit more too complicated for this webinar, we haven't touched on offshore trust planning and the changes announced by the budget in that regard. There might still be opportunities to shelter assets from UK inheritance tax for non-DOMs and others that are coming to the UK for the first time by using offshore trusts to hold those assets.
Thanks, Jamie. Before I move on to the next question, we've had a couple of people ask if we'll share the recording. Absolutely, it's being recorded, and we will be publishing it. Everyone who's registered will get a link as soon as it's available on our site and on YouTube. So just a couple more questions. Firstly, if you have an existing UK bank account, a current account, can you set up a savings account and gain interest on it while you're overseas, or is this not permitted? Jane, I think that's
yeah.
for you.
This is something we come across so often. It's not that it's not permitted; it's actually down to the actual provider. And at the moment, we're finding that a lot of people are being kind of locked out of being able to open further savings products or even current account products with their existing bank or with new banks in the UK, regardless of whether they're UK citizens or foreign nationals who are outside of the UK. It's a real issue. And some people kind of get around it by maintaining a UK address for those products. But in some cases, those providers are kind of finding out through having, sort of linked telephone numbers to the account and that kind of thing for contact. So it's something that we are seeing quite a bit of. And in most cases, yes, they kind of lock people out of being able to apply for new savings and other accounts.
Thank you, Jane. one final question before we wrap up. Excellent timing, everyone. I'm a UK citizen living in Abu Dhabi. How will the changes to non-dom status affect me, particularly with respect to taxes on worldwide income?
The changes announced in the budgets and the abolishment of the non-dom regime probably shouldn't impact you from an income tax perspective. You're non-resident, you're living in Abu Dhabi, therefore you're not subject to UK income taxes anyway. I don't know enough about your personal circumstances and risks around if you were to return to the UK early, around your residency planning that you undertook when you first left, or what other UK assets you've got, but generally nothing has changed for you, I would say. You're non-residents, you're subject to tax with reference to our residency rules rather than accessing the non-dom remittance basis regime. Is quite common when we're referring to domicile. In this regard, it's all about somebody's nationality rather than their residency status. So a non-dom just means a non-Brit rather than a non-resident.
Great, thank you. We've just had a request for clarification as well. And sorry, Jamie, on the last question around the abolition of non-dom status and what that means for assets held by non-residents residents outside the UK, about these being outside IHT. Said you talked about non-residents. What you talked about UK residents, what about non-residents?
So a non-resident will depend, it would depend on whether or not they're within our inheritance tax regime. So post 5 April 25, are they within the 10 out of 20 year IHT long-term UK resident rules and therefore within our IHT regime? If so, then you need to consider your worldwide assets and your UK inheritance tax exposure might depend on where you're resident, whether the UK has a treaty in place with the country that you're resident. For example, Americans aren't going to be so hard done by this new regime because there is a UK-US estate tax treaty in place which determines who's allowed to tax what assets. It would be a bigger concern for somebody that is within our regime and not resident in a jurisdiction that has an estate tax treaty with the UK.
Fantastic. Thank you so much, Jamie. So it is coming up for 5 past, so we'll wrap up the session now. Thank you so much to all of you for coming along and sharing your insights. Obviously, we have covered a lot here today. If your question hasn't been answered, please do ask it using the link that was shared in the chat so that we can that will allow you to request an introduction to one of our experts who can help with your specific situation. As I said, we'll also be emailing this link to you afterwards along with the webinar recording. We have captured all of the questions that have been asked and we will do our absolute best to answer them in future content. So you will find plenty of blogs, guides, resources on our website, expertsforexpats.com, if you're looking for advice in any other areas of expat tax, finance and wealth management. And if you're looking for dedicated support in any of these areas at any time, you can always come to our website, use our free introduction service, and we'll connect you with an expert in your specific situation. So thank you so much to our panel and thank you all for attending today. I hope you have a great rest of your day.